Alternative assets include hedge funds, private equity, collectibles, and cryptocurrency. These assets are characterized by risk profiles that are orders of magnitude larger than cash and cash equivalents, bonds, stocks, real estate, and commodities. As a result of their risk profiles, owning them requires sophisticated financial knowledge or advice and investing experience. In addition to the huge profits they could deliver, some of these assets are also non-correlated with stocks and bonds and could help diversify asset portfolios. Now let's take a closer look at the different alternative assets. Hedge funds are limited partnerships of private investors whose pooled funds is managed by professional fund managers who employ a variety of risky strategies in pursuit of above-average returns. They are a risky alternative investment choice and usually require a high minimum investment or net worth. Hedge fund returns rely on the skill of the fund manager, like the famous Bill Ackman of Pershing Square Capital Management. Moreover, their returns are meant to have little correlation with the stock and bond markets. So, diversification and outperformance are what hedge funds promise. But do hedge funds consistently keep this promise on average? A 2022 study by Javier Estrada showed that very simple two-fund or two-ETF strategies based on stocks and bonds outperform hedge funds both in absolute and risk-adjusted returns over the last 10, 15, and 20 years. Worse still, the study found that hedge funds were highly correlated with equities by up to 89, 85, and 83% in the last 10, 15, and 20 years respectively. Javier's research used the HFRI Institutional Equity Hedge Index as a basis for hedge fund performance and showed that in the aggregate, hedge funds may not be the best alternative asset out there. Private equity involves investing in non-publicly traded businesses. It appeals to institutional and high net worth investors as returns are not as volatile as or correlated with those of publicly traded equities whose share price fluctuates daily and can see dramatic changes due to their highly liquid nature. There are three ways to invest in private equity: through venture capital, mezzanine finance, and leveraged buyouts. Venture capitalists invest in startups that they someday hope to either list on a stock exchange through an initial public offering or profitably sell to another company. A great example of this is Peter Thiel's early investment in Facebook, now Meta Platforms. Mezzanine financiers loan funds to late-stage startups or to established private companies that can no longer borrow money from their traditional bank credit lines. In exchange, these financiers get the high coupon rate subordinated debt of the startup or private firm. This type of financing can be significantly more rewarding when compared to typical corporate debt, and it often returns between 12 and 20% a year in interest. As this chart from the PitchBook shows, there is a renewed interest in mezzanine financing following a slump in 2021. Leverage buyouts involve taking a publicly traded company private, either for its stable cash flows or to restructure and refloat it on the public markets at a profit. They declined in popularity after the 2008 financial crisis, but they are once again on the rise. Elon Musk's Twitter acquisition is a great example of a recent leveraged buyout. Collectibles are personal items that are worth more now than they were when they were originally acquired. Examples include artworks, antiques, stamps, coins, trading cards, toys, and comic books. Ideally, collectibles should pique the passion of the collector. The rarer a collectible is, the higher the price it would fetch on the market. Moreover, the value of collectibles tend to appreciate with time. They can help diversify portfolios and are fun to hold. For example, driving your vintage car on the weekends as a collector would be thrilling. Moreover, they could fetch hefty profits when they are finally sold in the future. However, investing in collectibles comes with risks. Firstly, the collectibles market is plagued by fraud and fakes. Secondly, collectibles are fragile and the slightest damage can wipe out their value. Moreover, matching collectibles to buyers who value them as much as you do can be tough. Lastly, storing, securing, and insuring collectibles can be expensive. Like other asset classes, you profit from collectibles by selling them at a higher price than you originally paid for them. But the tax on the sale of collectibles is usually much higher than on stock and bond sales. Plus, you get no dividends or income while holding them for the decades it may take for their value to appreciate. Cryptocurrencies are digital stores of value or payment systems that don't rely on central banks or trusted third parties to verify transactions or create new currency units. Instead, they use cryptography to confirm transactions on a publicly distributed ledger called a blockchain. The first cryptocurrency, Bitcoin, was developed in 2009 by a computer programmer using the pseudonym Satoshi Nakamoto. This alternative asset is extremely volatile. For example, the price of Bitcoin has hit a high of $69,000 and a low of $4,000 in the last 5 years. Now that's a wild ride.